Welcome to the Financial Modeling Podcast, where we discuss the latest trends in financial modeling, from AI and machine learning to automation and model auditing. This is your number one source for financial modeling news, tips, and tricks with your host, Matthew Bernath.
Hi everyone, and welcome to the next edition of the Financial Modeling Podcast. I'm sitting here with Alan Chan. Alan is an inflation rate trader at RMB. I'm sure he can explain it more succinctly than I can. And we're just here to discuss inflation, trading, and some market indicators and where financial modeling sits within all of this. Hi Alan.
Good afternoon, Matthew.
So I probably got your title wrong. What is your title and what do you do here at RMB?
Well, the title is a bit difficult. Effectively, I'm an interest rate trader on the inflation desk here at RMB, although our job spec does include a lot more things than just buying and selling instruments. I think at RMB, we do have quite an entrepreneurial mindset, and in the particular business, I mean, the business building side of what I do is quite a significant portion. So it's not just purely buying and selling.
So what do you actually do then on a daily basis? Talk us through your typical day.
All right. So considering we're a fairly niche area, we get involved on structuring, we get involved in seeing a lot of clients, we get involved in trading the markets. Effectively, a lot of it is to do with managing pricing and hedging of risk, and specifically on the inflation-linked interest rate side.
Obviously, this podcast is primarily focused on financial models, and presumably you see quite a lot of those and maybe do a bit of your own modeling as well. So where does inflation sit within all of this, and how does it affect financial models?
Okay, so a lot of this is driven from the client side, so it depends on what exactly is the particular need at a particular point in time. In terms of modeling, again, same as just about any other model, it depends on what's the purpose for. No model is perfect, but you try to give it a flavor which allows you to perceive reality in a different way, or maybe make some informed decisions about what to do.
If I'm building a financial model, one of the things that my financial model takes into account is my expenses going forward. So maybe I want to forecast for the next 10 years, I've got to forecast expenses. And maybe one of the things I've got to forecast is my salaries of my staff, and I might say my salaries of my staff increase, I'm going to give them increases of CPI. How do you forecast that? How would I forecast that in my model?
Well, in essence, it depends on what exactly you are forecasting. For the purposes that we generally look at, we build our forecast around what is market consistent. In other words, what is out there in the financial markets in terms of how the markets themselves price inflation. So it's not necessarily an accurate reflection of inflation, it's more an average of what everybody else is actually thinking and the bets that they place on inflation on the back of that.
Obviously, inflation is different around the world. I mean, for example, inflation in South Africa, if we forecast it at 6%, I assume in the US it would be a lot lower. So how does inflation work around the world, and why is it so much lower in some countries than in other countries?
That's a tough one. It depends on the macroeconomic variables in a specific country. South Africa has traditionally had a higher inflation rate, and higher inflation rates are more associated with emerging markets. Generally, in an established market, a lot of the small variances in the economy has already been ironed out, and on the back of that, you find that it is easier to manage your inflation rate. And generally, the more developed markets have a lot more capacity to target a lower inflation rate than, say, the emerging markets, which are a lot more exposed to external factors.
You're obviously looking at the financial markets all the time. What sort of indicators do you look for in the financial markets, and what are the things that the average person on the street can look for that might tell them whether we're in a bull or bear market?
Well, essentially, the bull or bear side is fairly simple. If prices are going up, we're generally in a bull market, and if prices are going down, we're in a bear market. Interest rates obviously work inversely, so if yields are busy going up, the relative prices are actually dropping, so we're in a bear market, and if yields are dropping, then we are in a bull market. Some of the things to look at from our side, we look at economic indicators as well as different market levels. So we would look at where is the currency, we would look at where interest rates are trading, we would look at equity markets. Oil is a big factor. You can bring into play things like soft commodities in terms of food prices, where things are going for specifically inflation-linked markets. And then on the economics side, you are looking at central bank decision days. You're looking at when CPI releases are coming out. You're looking at when financial speeches are being made, like say the budget or the medium-term budget policy statement, as now happens to be tomorrow. The number of things to look at is roughly endless. In terms of trading, interest rates, or just in general, there are quite a lot of people who look at history, specifically on the technical side, to see what has recent history produced. In other words, they don't look at any data whatsoever in terms of economic data rather, but purely focus on the historic price action of an instrument. So there is a whole host of things to look at. From our side, we look at the major factors is pretty much CPI, our Monetary Policy Committee decisions, and that's already 18 different points of the year. And on top of that, like I said, the budget, medium-term budget policy statement, and a couple of other things. Obviously, political events are quite significant, and news in general pretty much features somewhere along the way as well.
What advice do you have for aspiring traders and people that want to get into trading?
Well, it's a tough job, one could say. I think it is challenging. It's certainly never boring in my experience. So I think position sizing is quite key in terms of don't arrive there with a gambling mentality and place everything on one horse. Rather try to diversify through time by taking much smaller bets more regularly. I think it is important to know what is your competitive advantage. It is quite important to apply a certain level of discipline. And in general, you need to enjoy what you do. You need to have fun.
Just one more question. Where do you see trading going in the future? Obviously, there's a lot of talk about things like artificial intelligence and machine learning. And do you think that computers over time will be able to trade as well as humans and identify all these different news factors? Or do you think that it's still going to be a while before trading is disrupted by artificial intelligence?
I think artificial intelligence, or the use of computers in general, already adds a lot of disruption. I think there's a lot one can still do. Obviously, the more complex the systems become, the more useful software becomes in terms of interpreting that software. Ultimately, though, I do think that there will always be a need for decision making. And I think as long as there are humans out there, you're likely to have some level of uncertainty managed by humans.
Thanks very much. Thanks, Alan. Thanks for your time.
Thank you.
That was Alan Chan from the Inflation Desk at Rand Merchant Bank. Very interesting to hear what the trends are in trading and how financial modeling relates to it, and also where it might be going in the future, especially when it comes to topics such as artificial intelligence, data science, and machine learning. To get notified about my latest podcasts, please subscribe on the website financialmodelingpodcast.com. And for any questions you might have for any of my previous guests on the Financial Modeling Podcast, please email me at matthew@financialmodelingpodcast.com. Thanks for listening, and I'll see you next time on the Financial Modeling Podcast.